And welcome to On the Money with Secure Money. My name is Cynthia DeFazio, and I'm joined today by Brian Quaranta. He is founder and president of Secure Money Advisors, as well as joined by Neil Major. He is senior investment advisor. Brian, how are you today?
I'm doing great, Cynthia. How are you today?
Fantastic. Thank you so much for asking. And Neil, how are you?
I'm well, Cynthia. How are you?
Doing really, really well. Thank you.
Good.
I'm so excited to have you both in the studio today because obviously every time we're together, we're talking about such an important topic, planning properly for retirement. And a lot of people in the viewing audience today, they might think they have a plan just by grabbing statements out of the mail, but that is not a plan. So Brian, you're passionate about people being on the right track for retirement. Let's talk a little bit about what that is in case someone's watching for the first time today.
You know, we call that pile out of the mailbox the POS. That stands for pile of stuff, by the way.
Yep.
Right? But we do. I've been doing this for 23 years, and the first question I always had when people would come to the office is, did they bring their POS, which means their pile of stuff.
Yep.
And when people have a pile of stuff, that means they're very serious about retirement. They just need to get organized. But yeah, being on the right track, I think, is something that a lot of people don't know whether they are or are not on the right track. Because I don't think retirement planning has been explained very well to the consumer. A lot of people think retirement planning is making contributions to a 401k plan or an IRA account, but that's a very small portion of the whole planning process. Retirement planning and being on the right track includes the 5 key areas that Neil and I always talk about on the show, on the radio show, and our educational events is the income strategy, the tax strategy, the investment strategy, healthcare strategy, and even your estate planning strategy. That really completes a thought out plan where every I is dotted and every T is crossed. So getting on the right track is very important for people, but how do you know if you're not on the right track? Because a lot of times when people are meeting with their advisors, they're only going over performance. Your account did well this year, you earned X amount, it's gone up a little bit, but people aren't really having real conversations about planning and those 5 key areas. And so a lot of people are just not getting the advice that they should. But you're starting to see a change in the industry. I mean, you're starting to see, Secure Money Advisors, we are a fiduciary, so we have to do what's in the client's best interest, but we also have to provide a plan. And for the longest time, our industry was very transactional. It was buy a mutual fund, buy a stock, but we're starting to see a big shift in the industry, which I'm very optimistic about because it's been needed. We're starting to see regulation come to where they're going to start getting rid of commissions, which is great because you really don't want an advisor incentivized earning a commission. That's true. When they buy from you. The way that we're structured is we do well when our clients do well. So we've got skin in the game. So, but getting on the right track is exactly what we help people do at Secure Money Advisors. We're doing it every single week. We see 25 to 30 people a week that have that same question. Are we on the right track?
For sure.
Absolutely.
And what we've identified is that, most people just don't have the game plan.
Right.
And so when we say right track, they say, I don't even know what they're talking about. Yeah, my advisor says I can retire. And that's the end of it, right? That's the planning advice that they're getting.
He says I'm okay.
Yeah, that's it.
I mean,
I'm okay. What does that mean?
Like okay.
I'll be all right.
Yeah.
I'll be okay. Yeah.
And so think about some of the stuff that we're able to provide these people that are coming in. And one of the things that we do is we evaluate their investments, and we want to see, how are they positioned? Are they positioned properly? Do they have a great efficiency in their portfolio? Are they getting the return for the amount of risk that they're taking? Do they have any idea the amount of risk that they're taking? A lot of times people will come in there and say, I'm a conservative investor. And when we do the analysis, their portfolio has a drawdown of 40%. 35, 50%.
Yeah, and we should talk about that analysis because that's a big deal.
Absolutely.
The analysis that we do at the office because, we're quantifying risk today in a way that we've never been able to quantify it before because of technology. back in the day when we would identify someone's risk tolerance, we would do it through a questionnaire. And of course, the advisor would ask a number of questions, and based on, the answers from the client, you would determine whether or not they were conservative, moderate, or aggressive. But today, things are very sophisticated. We use a very sophisticated software at the office, which allows us to remove our opinion, which is great, because when people come in and we do an analysis for them, it's truly an analysis, right? We've got no agenda other than delivering the data to you. That's it. Okay. And when people have that black and white information, they can make informed decisions. But the risk is quantified based on a number now. So, for example, our risk analysis quantifies the risk from a score from 1 to 99. Okay. So to give the viewing audience an example, the S&P 500 index, which most people know, has a risk score of 75. All right. So a lot of times people come in and they'll say, well, I've asked my advisor to be conservative for me, and we'll run it, and the risk score will come back, and the risk score will be an 80. And so they're actually much riskier than the market, and they've asked to be conservative. And so a lot of people are taking someone else's word for it that they're positioned the way that they've asked to be positioned. This is not about telling you, we've got you in a conservative portfolio. No. This is identifying it and quantifying it based on the data from each of the positions that you have. Because when we get the statements and do the analysis, we enter in every single position that they have, and the software analyzes it based on all the historical data that's available on that mutual fund, on that stock, on that bond, and it quantifies that risk score. And boy, it is eye-opening for people when they come in, isn't it?
Yeah, absolutely. And the other challenge is, I think, because the market has done so well since 2009, people really have no idea how well they're doing or how well they could be doing.
Right.
They just see it going up each and every month when they get their statement. So they really have no idea, and this really, we're able to quantify, like Brian said, the amount of risk they're taking, the performance. I had a couple come in not too long ago. They're taking the same amount of risk as the S&P 500. So if you're going to take that amount of risk, you're going to hope that you have a similar return, right?
Sure.
Well, over the past 5 years, the S&P 500 has done over 18% in return. Well, they came out at a 13% return over the past 5 years.
Wow.
So it wasn't an efficient portfolio. We're missing 5% somewhere.
Yeah, this is what we...
Over a 5-year time period, that adds up to significant dollars.
Yeah, and this is where we say, people are taking this much risk, and they're only getting this much return. This is the risk reward for investments. And what that software does is it quantifies that risk reward. So I have no problem with you taking risk, but if I'm going to take that level of risk, I should be getting that level of reward. I mean, do the math on missing out on 5% over 5 years. That's a big difference in the accumulation of that account value compounded. So, but that analysis that we do is absolutely eye-opening for people. And it's a big reason why people wind up onboarding with us, because they realize for the first time, how much risk they're really taking, how inefficient, as Neil talks about the efficiency of the portfolio, but how inefficient the portfolio is. The fees that are dragging down the returns, the unnecessary risk to get a very small rate of return. And so people now feel much more in control of what they're actually doing, because we're actually quantifying it based on real data, not opinion.
Sure. And how often can you run that report? Is that something that you do just the one time where they're in with you, or do you do it yearly? How does that look?
It depends on where the client's at. So, for example, Neil has a number of clients that, are still working. So he'll run that risk analysis on their 401k for them, right? And so he can run that risk analysis for them each and every year to see where the risk is and to see if it could be adjusted. Now, why does he do that? Because a lot of these people might not be at the age that they can actually take their 401k from their employer yet. So what we do is a lot of times the client might have positions that they have to hold outside of our firm, okay? And when I say our firm, we do everything through TD Ameritrade, which most people know who TD Ameritrade is. It's a big company. But they hold that on the outside, and we at the end of the day, somebody has to be the quarterback. And so us as the financial quarterback or coach, we're still taking into account what they have with us, plus what they have outside of us. And so we're monitoring that on a year-to-year basis to make sure that risk stays in check. Not only that, but you know, as we have clients hit milestones, we reduce that risk too.
Right.
You know, now for us, a lot of our clients are 55 and older. If we do have younger clients, it's because they've been referred to us. But that analysis is important to do. If you're still having assets outside of us, is important to do every single year.
Sure.
Yeah.
Thank you so much.
And Cynthia, that analysis, what we're able to look at, I remember in March of 2020 when COVID first hit and the market went down significantly, our phones were ringing off the hook with people calling in and saying, you know, 2019 was a great market year. My portfolio didn't follow the market the way up, but now that March of 2020 has hit, it's followed the market on the way down. Why is that? So this program really helps us identify the efficiency of the portfolio.
Yeah, you know, it was really interesting to us when the pandemic did hit.
Yeah.
How many people reached back out to us that had gotten the analysis and said, I see what you guys are talking about now. Because for the first time, we had quantified it for them, and then they actually experienced it. And so when they experienced the loss, and we told them that that was going to be the loss, they said, wow, maybe we better listen to these guys. Because we just have a better way of controlling risk. We use technology to control risk through the use of computer algorithms, which we can talk about on the next segment. But I want to talk about people today about getting an opportunity to sit down with us and get a right track retirement review, because most people don't know whether or not they're on the right track. And I want to help you get on the right track. And being on the right track means that you have 5 key areas that you're reviewing. Number 1, and most importantly, is your income. Number 2 is taxes. 3 is your investments. 4 is your healthcare strategy. And 5 is your estate planning. So for the next 10 callers who call in right now, we are going to give you a right track retirement review. It is complimentary. It's not very often that you get an opportunity to come in, sit down with a fiduciary at no cost, and have this level of analysis done for you complimentary. But you got to do your part. Pick up the phone, call us today, schedule with our office. It's 1-888-382-1298.
Brian, thank you so much. Neil, thank you so much. To the viewers at home, the phone number to call is on your screen, and that number is 888-382-1298. We do have to take a very short commercial break, but don't go anywhere. When we come back, I do have some viewer questions. The next one could be yours. Stay tuned.
See, everybody can tell you how to invest your money. There's not a lot of people out there and a lot of firms that can teach you how to use your money. Most people will also tell you that they're scared. And the reason they're scared is because they're afraid of running out of money.
The last thing you want to do is have a really good job into your 60s, retire, and be looking for work again in your late 70s.
The average person might say, well, a good portfolio would be a good mix of stocks, bonds, and mutual funds. No, 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 no. A good portfolio is all designed around the 5 key areas: income, taxes, investments, healthcare, and legacy planning.
We're not just product pickers here. What we do best here is we build retirement plans.
9 out of 10 people, when they walk through the door, would ask us, we just want to know if we're on the right track. And I always say, if you're not on the right track, when would be a good time to know it? Probably now.
People, can actually see a vision once we start to really build out their plan.
This is about you. If you're not getting what you need, and you feel that when you walk out of the advisor's office, it's time to get a second opinion. And you can't get a second opinion from the person that gave you the first opinion. The difference at Secure Money Advisors, as a fiduciary firm, we help you manage the risk, build the income, and give you the retirement you dreamed of.
And welcome back to On the Money with Secure Money. My name is Cynthia DeFazio, and I'm joined today by Brian Quaranta. He is founder and president of Secure Money Advisors, as well as joined by Neil Majors, senior investment advisor. Gentlemen, a great show that we're having today, and obviously I love this part of the show because we've had viewer questions come in from one week to the next. So I thought it might be really amazing for us to go ahead and address a couple of those. Would that be okay?
Let's do it, yeah.
Yeah, absolutely.
All right. Neil, this first question deals with Social Security, so I'm going to guide it towards you. It
Sure.
says, this is Ann from Pittsburgh. Neil, my ex-husband and I were married 25 years before we divorced. He passed away this year. He was 68, and I am as well. My question is, how is Social Security affected? Will I still be entitled to half of his Social Security even though he passed away?
Yeah, and I'm sorry to hear about your loss, but yes, you are still entitled to 50%, but in fact, you're actually, I believe if this is correct, you're actually entitled to his full benefit now that he's deceased.
Yeah,
Okay.
and that would be because she hasn't been remarried. She didn't say she got remarried, right?
No, she
It
did
is her
not.
ex-spouse, right?
Yeah.
Okay, yeah, so she'll probably be entitled to his full benefit amount. So,
Okay.
yeah, so she should be, as long as, the key here is that she doesn't get remarried. It doesn't sound like she's going to get remarried, but if you get remarried, that all goes away.
Okay.
And you wouldn't be able to take it. But if she hasn't been remarried, she still is going to be able to get her Social Security amount off of her spouses.
Okay.
Yeah.
Okay, perfect. Brian, this next question is to you, actually. It says, I'm 64, still working. I make $130,000 plus a bonus each year. I don't have any debt, and I don't own any property. I am about to inherit $1 million, half of this month. I have a decent 401k. Where should I invest the inheritance? Would real estate be a viable option for me?
Yeah. So, I mean, this is why planning is so important, because the question, again, this comes right back. When we teach people about the 5 key areas of retirement planning, our clients don't have questions like this anymore because immediately they know what to do. So the first thing you're going to go to with a question like that is you're going to say, okay, well, how is the individual's income? All right? Because if this person wants to retire, okay, they want to do things in retirement, they want to gift money to kids, whatever they might want to do, they want to travel, they're going to need income. So the first question is, let's talk about the income, because the $1 million inheritance may need to go towards building out a income strategy first before anything else. So once the income's been taken care of, then of course now you can start to look at the mitigation of taxes, because this is going to be an inheritance. I don't know, did they say if they were going to, that was an IRA or a non-IRA? I don't think it did, right?
No.
Because we've got a problem if it's an IRA, because the IRA is going to force that individual to take all the money, which is going to force them into paying a massive amount of taxes. As a matter of fact, what was it? 2019 was the Secure Act, right?
Right.
Yeah, tell them a little bit about that, because that can really affect this person, is the Secure Act.
Okay.
Yeah, so what Brian's referring to is in the Secure Act on inherited money in IRAs. They changed the law, so you no longer have a lifetime to inherit an IRA. You only have 10 years. So if you have $1 million in an IRA, she's only going to have 10 years to remove that money from the IRA and pay the taxes on it.
Yeah.
Wow. Okay.
So and was she the one that has the high income?
130,000 a year
Yeah.
Yeah.
plus bonus.
Yeah,
So
so
that's a
we don't
problem.
know if she's married or single. So
Right.
that there become the challenges. We don't know what age she is. Is she going to retire? Would we be
64,
better off?
I think she said he
So
was,
I'm
right?
64, still working.
So,
Okay,
but
got it.
to the point, she's got high income. So if it is an IRA account, there's going to be a problem there, because the IRS is going to force her into a 10-year drawdown of that money. So every time money comes out of that account, it's going to get added to her $130,000 a year plus her bonus, whatever
Right.
she's getting.
Okay.
So now she could be wind up paying taxes on $250,000. My gosh, if she's single, even if she's married, she's going to be in a very, very high tax bracket. That $1 million is not going to be a $1 million inheritance if it's an IRA account. It's probably going to be more like a $700,000 inheritance versus $1 million the time we get done paying taxes on it.
Yeah.
So there's more of a problem there than what do I do with it and how do I invest it? Because the first question, regardless of whether it's IRA or non-IRA, we have a tax problem.
Yeah.
Okay. So that has to be handled first, and then of course, number one and most importantly, the foundation behind making sure that you're taken care of is making sure you have a good income plan. So there's a lot in that question right there. That can be deciphered, but a lot of problems that I see too with that. So this is why it's so important to work with a comprehensive financial planning firm.
Absolutely, because what it comes down to is no one's situation is exactly the
Correct.
same. And
Right.
it's really impossible to have an answer for something so diversified without meeting that person face to face.
You change a few of the variables on there. You
Yeah.
can have that same person. You could say, I'm inheriting $1 million, and you could just simply change the fact that they're married
Yeah.
versus single. Completely changes the game.
Yeah.
You could say that their income is much lower than what hers is, and it completely changes the game. So those little nuances change everything. in the way that you approach it. And it's one of the things I always tell this to the team. You know, we're more than financial planners. We're really financial engineers, because you are engineering something here, and there's so many moving parts. And if you touch this, it affects this. If you touch this, it affects this. So you got to be very careful, even your planning model, that you build it out appropriately to maximize what can be maximized.
That makes perfect sense.
Yeah. So I just had an example, because I had a woman come in who inherited a bunch of money from her brother, and the market got volatile on her, and so she started to experience 12% loss. Now, she's 78 years old. She doesn't want to experience 12% loss at this point in her life, and she needs the money for income, right? So here's one of those little nuances, right? She has short-term capital gains on the money that she inherited. She had taken some out initially, the money grew really well, and then all of a sudden it pulled back. So she wants safety, but we have to be very, very careful and not impact the short-term capital gains on the other side. So, you know, like financial engineers, you got to make sure that you piece everything together, and you don't make a little mistake for a client that's going to cause them a big headache.
Sure. Thank you, Neil. Well, Brian, I know that you and Neil have a very special offer to present to the viewers at home. Let's talk a little bit about that again before we reopen the phone lines.
Sure. Our Right Track retirement review, Cynthia, has been really designed with the viewer in mind to help you determine whether or not you're on the right track. And I always say, if you're not on the right track, when would be a good time to find that out? So for the next 10 callers who call in, we are going to provide you with a complimentary Right Track retirement review, where we're going to go over the 5 key areas that we talk about all the time on this show: your income, taxes, investments, healthcare, and of course your estate planning. But you got to do your part today. You got to pick up the phone and you have to call us. Remember, retirement is not a dress rehearsal. We do not get a second shot at this. We have to get it right from the very beginning. So do your due diligence, work with a comprehensive financial planning firm, and more importantly, schedule your complimentary Right Track review with us at 1-888-382-1298.
Brian, thank you so much. Neil, thank you so much. To the viewers at home, the phone number to call is once again on your screen, and that number is 888-382-1298. We're going to take a very short commercial break, but don't go anywhere. I have so much more with Brian and Neil when we return.
If I could help you increase your income, if I could help you pay less taxes, if I could help you potentially maximize the returns of your investments while reducing risk, reducing fees, if I could help you prepare for a health event, or more importantly, when the good Lord decides to take you home, to make sure that the money you've accumulated over your lifetime goes to your family and to your charities rather than the IRS, would that be worth the time to come in and get a second opinion?
And welcome back to On the Money with Secure Money. My name is Cynthia DeFazio, and I'm joined today by Brian Quaranta. He is founder and president of Secure Money Advisors, as well as joined by Neil Major, senior investment advisor. Gentlemen, a wonderful show, and I love this part of the show specifically because we get viewer questions, and we never know what people are thinking until we actually open some of these. It's really great. Neil, this is a great question. I'm going to guide this towards you. It says, Neil, I'm very curious about lowering my taxes. Is there a strategy that you would recommend for me? I've heard that Roth conversions are good for most people.
Yeah, interesting question, and obviously there's a lot more data that I would need in order to guide you on that question. I will tell you, Roth conversions, Roth IRAs are kind of a hot topic. We're hearing a lot about them and how they work, and they make a lot of sense to people. It just doesn't apply for everyone. So I don't know if most would be the right word there.
Okay.
Yeah, we certainly, when you work with someone like Secure Money Advisors, we want to make sure that we're utilizing all strategies to further the chances of success for our clients. Now, I'd have to really sit down with you and understand your situation to let you know if a Roth conversion made sense for your case, though.
Okay.
But, you know, I mean, I think from the purpose of just reducing taxes, you know, Roth conversions will not reduce taxes right now. They'll reduce taxes in the future, because in order to convert, right, it means we have to pay taxes.
Right.
So, did she mention how old she was there?
No, she did not.
So, but let's just say she converted $25,000. That's got to get added to her income this year. So her taxes are going to go up while we're preparing to have lower taxes in the future, right?
Okay.
Now, if she's looking to lower her current taxes, you could go the opposite direction. You could make a contribution to a traditional IRA. You could make a larger contribution to your 401k, and those contributions will actually be deducted off of your gross income to lower your adjusted gross income and pay less taxes. The problem is, do I want to pay taxes on the seed or the harvest? Because if I save taxes now, it just means I've got more of a problem later on down the road.
Yeah.
Again, financial engineering, right? We move this,
Sure.
it changes this. So, and then of course, there's other ways. I mean, if she's, if she has the ability to start her own business, she could start a business. She could, file as maybe an LLC. She could start to write things off that she purchases for the business. I mean, so there's other ways outside of just retirement accounts that tax planning can take place. But again, I mean, just the simple answer is kind of the examples we just gave.
All right. Thank you so much, Joan. That was an excellent response. Brian, this is also a great question. It says, Brian, I'm 10 years away from retirement. I've been advised to pay off all of my debt. I have credit cards, mortgage, and car payment. What should I start with first?
Highest interest rate first. Actually, there's a great program out there called Transforming Debt into Wealth. I would highly recommend somebody that's struggling with debt to look it up. It's been around for a long time. But usually, we call this the snowballing technique. So you list out all your debts, you write down the amount that you owe on a monthly basis, and then you actually divide the amount that you owe on the monthly basis by the balance of that. So if I have, let's say, a credit card with $10,000 on it and the monthly payment's $50 a month, I would divide 50 by 10, okay, by the 10,000. I would do that for each account, and then you get numbers and you order them from least to greatest. It's called a payoff factor, okay? And then what you do is you start snowballing. So basically what you do is you put as much possible money as you can on one payment at a time, right? The rest of the payments you pay the monthly the bare minimum, okay? And then once that one's paid, you now roll that payment along with the next payment to the next one, to the next one. This way, the time you get to those other payments, that payment that you're making on a monthly basis gets bigger and bigger and bigger, because you're taking the $50 that you were paying on this one and the $150 that you were paying on this one. Now you add them together. Now you're making $200 payment on this one, and then when that one's paid off, you take the $200 and you add it to this $200 payment, and now you're paying $400 off.
Wow.
So now we can accelerate the debt. That's called snowballing, and we can get out of debt very, very quickly that way, and I would highly recommend it.
I'm learning something new every single time we're on the show together. I've never heard of that before.
Yeah.
That's amazing.
There you go.
I think the simple answer was pay off the credit card debt.
Yeah, pay off the credit card debt. That's the simple answer.
Unpack it just
Get
a
it
little
off.
bit more.
But people, I think people, when they have a system to pay debt off, right?
Yeah.
They feel back in control, because a lot of people that have debt feel out of control.
Right.
They don't feel like,
true.
the nice thing about snowballing is that you actually can determine the date in which you'll be out of debt. And that's nice, because a lot of times when you're paying off debt, you're like, is this ever gonna end?
Yeah.
Yeah, so, but to Neil's point, just pay the damn thing off.
Make it be gone. Well, Brian and Neil, we're down to the final minute of the show this week.
Yeah.
Any final words of wisdom and advice that you would like to give the viewers at home?
Yeah, have a plan, right? And wouldn't you say have a plan?
it. Have a plan.
Plan, prepare, and that's the best thing. But our viewers, what we've done for you is we've put together our Right Track Retirement Review that helps you determine whether or not you're on the right track, whether or not you're doing the right things. Most people don't know whether or not they're on the right track. This is an opportunity for you to find that out. So for the next 10 callers, we are going to give you a complimentary Right Track Retirement Review when you come to the office. The phone number to call to schedule that appointment is 1-888-382-1298. Again, call us today to schedule that appointment at 1-888-382-1298.
Brian, thank you so very much. Neil, thank you so much. To the viewers at home, most specifically, we would like to thank you for spending time with us. That number is 888-382-1298. We know you have a lot of questions about how to retire with confidence. Brian and Neil have the answers for you. Be safe, be happy, be blessed. See you back here 1 week from today.